All right. Hi, everyone. We are live. Welcome to Market Matters. My name is Katie Kuntz, and I'm a social media editor here at CNBC. I'm joined, as always, by our senior markets correspondent, Bob Pisani. And today we're going to be answering all of your questions about the latest stock market moves. Nice to see you, Bob.
Hello, Katie. You're in LA still, right?
Yes, I'm out on the West Coast. How are things?
We had a little earthquake tremor here. It was centered in New Jersey, not far from where our home studio is. But I'm in Philly right now, and I actually felt it. It was apparently a 4.8 earthquake centered in the middle of New Jersey. But when you feel it, I was probably 60, 70 miles away from it. And I felt that a little bit upstairs by my closet. This closet moved a little bit.
Yeah, that's definitely not something
we're rare thing. Earthquakes in New Jersey? No, I don't think so.
I would have thought that I'd have felt one out here. I've been out in California for 6 months, and no earthquakes yet for me. But yeah, I'm glad everyone's doing okay out there on the East Coast. Anything else new with you, Bob?
No, the business has been good. We had a great first quarter. I hope we can chat about that a little bit. Doing a little traveling. Was in the Bahamas. It's lovely country. I'll tell you something, Katie. I know money's tight for some people, but travel business looks fantastic to me. Airlines are booked. The cruise lines. Viking announced they're going to do an IPO. You know about all the other ones, Norwegian Cruise Lines and Carnival, but Viking announced an IPO. That's how strong the booking business is in travel. So people are traveling, and prices are up. I was in the Bahamas. It was fairly expensive, and yet it was beautiful. Weather's beautiful. The beaches are beautiful. The people are wonderful, and everybody's having a good time. But no slowdown. You saw that today in the jobs report. Jobs are still strong.
Yeah, exactly. All right, well, let's jump into our questions for this week, Bob. First up, like you said, we've wrapped up Q1. So how did stocks finish up in the first quarter?
It was great. So the S&P, which is what I watch, it's the broadest index. You own the whole, essentially, S&P 500. That's 80% of the stock market in the United States. Was up 10%. But it was a broad advance. People like to mistakenly say, oh, it was just Nvidia or a few tech stocks. It wasn't. The advanced decline line, how many stocks go up every day versus how many go down every day, has been going up for 5 months. That's a broad advance. That means it's not just a few tech stocks. So we had, for example, energy stocks have been very strong. Small part of the S&P 500, but a lot of names are at new highs because oil's been up. Natural gas hasn't, but oil's been up. And other sectors have been strong. Financials have been strong because insurance companies are up. They've been able to raise prices recently. They're up. Credit card companies like American Express and MasterCard, they're up. The banks, depends on which ones you're talking about. Some of the bigger ones are doing okay. Citigroup and JP Morgan are up. And industrials have been very strong. General Electric, my old company, the energy business, Vernova now, and GE Aerospace hit a new high. That's just a one company, one business now, aerospace. Eaton Power Company, Parker Hannifin, also big global industrial, new high. Caterpillar, construction equipment, new high. Material stocks like Freeport-McMoRan, big copper company, doing really well. And tech is actually lagging. I mean, Apple's down this year. Intel's down this year. Cisco's down this year. Nvidia's up big, but and some other things are doing well. Hotels are doing great. I just back from the Bahamas. I mentioned their travel's doing well. Home builders are still up, even with the slightly higher rates. Amazon's doing really well. Tesla's having a lousy year. So some stocks like Tesla, Tesla's down 30%. But by and large, the market's advancing because the breadth is really strong. And that's why I'm not that worried, right? I'm not worried about a 1 or 2 or 3 or 4% decline. We could talk about what would constitute a bigger decline, what would have to happen. But right now, the economy is still good, even if there's this issue about sticky inflation that's out there.
Well, we'll definitely see where things go in Q2. Like you said, we had more jobs reports. What did we learn?
Well, we learned the job market is still strong. I mean, 300,000 jobs, that's an awful lot. I mean, that's really a strong number. in case you're wondering, if you don't keep track of this stuff, job growth, we watch this because there's a number of new jobs that are out there, was 200 to 300,000 for the last year, essentially. And this is among the higher readings. The single most important thing about the US economy is jobs, because most people, that's the way they judge how well they're doing. And that matters a lot, and particularly in different services, like the services industry. Services is everything from 70% of the US economy is services. So people work as waitresses, they work as insurance salesmen, they work in what I do, reporting. That's a service business, essentially. So anything that's not in manufacturing is largely a service business. So that's really doing well right now, as I mentioned. So when you have that humming along, it's hard to have any kind of serious downturn. Job growth is still strong, and that's the most important thing.
All right, Bob, everyone's talking about Nvidia recently. Is it in an AI tech bubble? What do you think?
No, and I'll tell you why. This is one of those very rare stories where, oh my God, it's up 200%. That's amazing. And under normal circumstances, the idea that it would be up another 200% would probably not happen, because you get reversion to the mean. Stocks, no stock does that. Everybody thinks Microsoft is this gigantic, brilliant company, and it is, but I would encourage people to go back and look at Microsoft from 2000 to 2010. It actually was down. It was negative. Apple had terrible performance for several years after 2000. About 2005, it started rallying. Amazon was a terrible performer in the 2000s. So this idea that tech stocks don't go anywhere but up is just wrong. Most of them do mean revert after a while. Nvidia may be a little bit of a special circumstance because there is a once in a lifetime thing going on. Just like what really defined the 1990s was the birth of the internet. That changed everything. AI is also now another new paradigm that is also changing everything. And they're an essential company there because they make the picks and shovels. They make the semiconductors that go into the servers that enable you to do these things, and the computers that enable you to do the AI calculations. So they don't write the software, but they have the hardware, and you can't do it without them. Other people are involved in this too, obviously, but they're the main one. So their earnings numbers have gone up almost commensurate with the stock prices. And so you can't look at Nvidia and say, oh, this is stupid, ridiculous stock, because there's no relationship between price and the earnings. Nvidia is trading for, I don't remember, around something like 31 or 2 times forward earnings, maybe a little bit more. I mean, that's higher than the S&P. The S&P is 21 times forward earnings. But for a company like Nvidia in this extraordinary business called artificial intelligence, that's not outlandish at all. So my sense is, look, if you think that Nvidia is going to go up 200% again in the next year, you're probably wrong. If you think Nvidia might outperform, that might be outperform the S&P. That might be a reasonable expectation, but it doesn't mean it's necessarily going to be up. If the S&P is down, 6% in the next year, and Nvidia is only down 3%, that's outperformance, but it's still down. I don't know. All I feel strongly about, and I don't give advice on buying and selling stocks or anything like that, all I do feel strongly about is that just on a fundamental basis, Nvidia is not overpriced, and it's an extraordinary story.
All right, Bob, next up, let's talk about TLT. What are your thoughts there?
Well, so TLT is the 20+ treasury, and you're buying longer dated treasuries at this point. So everybody, I think you all know, investors are in love with 4 and 5% yields anywhere they can find it, and for good reason. For years and years and years, in the 2010s, nobody got any yield on treasuries. Nobody got anything. I mean, at one point we were below 1%. Think about this. I mean, it's absurd to give the government 1% return. That's nuts. And yet people did it. I think all that's over. I think the long, slow decline of yields are over, and I think it's a good thing. People sort of, the downside is people thought that somehow it's normal to have a 3% mortgage. It's not normal. It never has been. I've been doing this for decades, and a normal mortgage is 6, 7. My mortgage in 1985 was 11.2%, 30-year mortgage. Somewhere between 6 and 11 is more normal. It's the 3% that's not. And so people are complaining about 6% mortgages or 7%, but it's better. And nobody's complaining about 4 or 4.5% 10-year, because suddenly you actually get a return for investing in government bonds that's above the rate of inflation even. Well, that's fantastic. I'm in favor of that. That's more normal. So what this all means is bonds, because you're getting this 4 or 5% yield, people are saying this is great. It's risk-free. Stocks, long-term, you get a better return from the stock market than the bond market, but stocks are riskier. So you could lose money easier on stocks. It's no guarantee. That's why you long-term make more money, because the market is riskier. At any one moment, bonds could outperform stocks, and they did. You go back into the 2000s, and you will see bonds, holding bonds, if you know how to evaluate this, outperform holding stocks. That generally doesn't happen, but there have been periods where bonds outperform stocks. So the question now is, okay, I love my 4 to 5% yield. How can I make sure that continues? And last year, everybody was having short-term bonds, like less than a year, because they were paying 4 or 5%. Now, if rates are going to be flattish to slightly down, maybe, like some people think, it might be better to go a little further out on the yield curve, maybe into people are talking about buying intermediate, like 3, 5, 7s, and that will offer you a more stable return somewhere in the 4 or 5% range. 20 plus is a little more risky, in my opinion. Again, I don't advise people, but TLT has had a lot of flows recently, as well as flows in the intermediate range. And intermediate, again, is like 3 to 7 year maturation. So there's still inflows in this area. And again, I'm not telling you if you should buy TLT or not. I'm telling you that I think that the likelihood that we go back to where we were, 3 or 4 years ago, where you're getting almost no return on a money market fund, or even if intermediate term bond, I think those days are gone, and I think it's terrific that that's happening. And one of the consequences is bonds are now competition for stocks. There are people in these money market funds getting 4%, and they love it. I asked people, like, don't you want to? I mean, the stock market's been outperforming that easily. And the S&P is up 25% in the last 5 months. People say, that's true, but I feel safer in bonds. And you do get the safety of bonds. U.S. government is not going to default. That's for sure. So people like that safety, and they like that 4 or 5%. And, God bless them. And what that means is those people aren't putting money in the stock market. So the stock market is suffering a little bit because those people are happy getting their 4 or 5% yields. And you know what I say? God bless them. You need to understand your risk tolerance. What they're saying is, my risk tolerance is not that high. I might, instead of having 75% of my 401k in the stock market, I'm concerned about a pullback, I only have 50%. I think if you're a young person, that's a mistake. There is no reason for you to be worried about this. Long-term, 1 year performance doesn't matter at all. You want to be in the market all the time. Remember, if you're 30 years old, you're going to live to 90 or 100. That's a long, long time. 2024 is not going to matter when you're 30. You're going to live to 100. It's not. Even if it's down, it won't matter. It's being in the market, not trying to time the market, that really matters long term. So again, I'm an old school guy. I wrote a book about this. And I publish what I own. I have about 75% of my 401k in stocks, 20% in bonds, 5% in the money market fund. I've had that for many, many years, even when bonds were given no return, because bonds provide some ballast in your account. It's risky to own 100% stocks, even, and I don't own individual stocks. I own index funds. I own the S&P 500. I own a small cap fund, but it's risky just holding bonds, stocks. And with the returns that you're getting on bonds now, it's really very attractive. So I'm perfectly happy with my 70% stocks, 20% bonds, 5% money market. Money market's getting 4%. I think that's a very good way to go. Remember, I'm almost 70. So if anybody would worry, it would be me, because I'm not 30. I'm going to live to 90. At least I'm banking on that. I'm hoping that'll happen. But that means only 20 more years and not 60 if you're 30. So, you know, and I'm still not that worried, because 20 years is a long, long time. If I was more worried, what I would do is, again, risk tolerance, understanding risk tolerance. I'd reduce my exposure to stocks. And I may do that in the next, few years, but not now. I haven't appreciably changed my stock bond allocation in years.
All right, Bob, switching gears a little bit here. So we finally got Reddit's long-awaited public debut recently. So are we going to start to see more companies go public?
Well, I hope so. And we had one today. Viking announced they had filed an IPO, but we don't know the terms. This is Viking, the cruise ship company. And the cruise ships have generally reported outstanding numbers. I mean, they're booked, basically. And that's a good sign. That's a very good sign. So what do you need to have a successful IPO market? Well, the most important thing is the stock market holds up, and recent IPOs hold up okay. That's doing okay, yes. Stable interest rates, certainly not going up rapidly. I would say it's a little bit in flux, but they're not going up dramatically. Okay, there's a little bit of flutter here in the last week or so, but I would say it's not dramatic. And after that, it's just valuation questions. A lot of companies had rounds of funding, particularly tech companies in 2020, 2021, that were very, very high. And now, when they're considering going public, the public doesn't want to pay those kinds of high prices. And so they're called haircuts, where you're going to have a lower round of a lower valuation than you wanted. So instead of valuing your company at, pick a number, $2.5 billion, maybe it's only $2 billion or $1.5 billion. So that will prevent a lot of companies from going public if they have to face a realization that their last round of private funding isn't going to match their public price that they want. That could be an issue. But as far as external market conditions right now, stock market, interest rates, it's pretty good time to consider doing it. And I'm hopeful we'll see a lot more. Frankly, it's been so far this year, okay, but not great in terms of numbers that have been going on. Okay, but not great. I'd like to see it accelerate. I think there's a real alarming decline in IPOs that have been going on for several years now, even before 2020. And frankly, it's very alarming. Companies have an easier time staying private than going public.
All right, and Bob, we started out today kind of wrapping up Q1, but we're about a week into the second quarter now. So, what are you looking ahead to in the second quarter?
Well, everybody's in the pullback prediction business so remember, we're up 25% in 5 months and 9% a year. I mean, that's a huge move. So everybody said, oh, this can't go on forever. So I call it the pullback prediction business. You should not be surprised to see some decline. We're 2% off the highs of a week ago. I would not be surprised to see some kind of 5% pullback at least. The bigger issue for me, I always look at probabilities. That probability of a 5% pullback in the next few months is very high, and nobody should be surprised. I deal with more bigger declines. So to me, that's not interesting, a 5% pullback. What would happen to require a bigger pullback? So I use 10% as a benchmark. What would happen for a 10% decline? Usually when you get those, you get the market. Remember, earnings are what matters, earnings, dividends. And you get the market When those kinds of things happen, you get the market usually concerned about some event because it means somehow they're mispricing earnings, that they're wrong. What would cause that kind of concern? Number one is a downturn in the economy, specifically jobs going south. That would be the number one thing. I don't see that. So the jobs report today. Number two would be some sudden move up in interest rates. Dramatic. We're a little higher than we were before. I still don't see that. Number three would be some kind of what we call an exogenous event, something that happens that nobody, thinks about. In the 1970s was the Arab oil embargo. That came out of nowhere, and that messed around with people for a long time, called inflation, really a problem. COVID really messed with people. A war. I think the Russia invasion of Ukraine really was a surprise. People didn't think you could have a conventional ground war in Europe. Nobody thought that was going to happen. Nobody. Yesterday, in the middle of the day, we had comments from President Biden that he had spoken to Netanyahu in Israel and told him how unhappy he was. And there were reports surfacing that Iran was considering retaliating against Israel in some way for what's been going on. Well, there's another prospect, Mideast tensions that have been around a long time, but suddenly get very real. And I think that was the main reason we dropped yesterday, because we had three things happen. Number one, we had a sudden spike in oil. Number two, we had a sudden spike in bond prices. Bond yields went down. So that's flight to safety. Somebody's buying bonds. And number three, the stock market dropped. All very quickly, all in an hour, those three things. So if you look around, those are sudden moves. And when you have sudden moves in all of those three at the same time, you look around for a cause. And the most likely cause was increased tensions in the Middle East, getting people concerned, the exogenous shock thing. Other than that, earnings have again been very strong. First quarter numbers have been good. They're a little lower than they were beginning of January, but that usually does happen because the analysts are usually too optimistic. And this is why the market keeps holding up so well. The economy, is strong overall. People ask me about this sticky inflation story. What about inflation? It stays high. I think the market has been anticipating inflation dropping and the Federal Reserve cutting interest rates. This isn't going to happen very quickly because, number one, the inflation numbers are coming down, but not fast enough. And number two, the economy is strong. The Federal Reserve why would the Federal Reserve cut interest rates when the economy is strong? It doesn't make sense. So I know the market in December was expecting 6 rate cuts. Now we're only expecting 3 and is heading towards 2 rate cuts this year. So I think these unfulfilled expectations that there was going to be rate cuts, it can take some air out of the markets. I don't think it's going to cause a 10% drop in the market. To have that, again, you need some kind of significant deterioration in the economy. So deal with probabilities. Don't deal with, this and that. 1 to 5% drop, I would bet on that sometime in the next few months. 10% drop would require some other conditions that I told you about. By the way, people ask me, well, that would be a catastrophe if we had a 10% drop. Actually, no, it happens a lot. People worry about economic weakness all the time. In my Trader Talk today, if you can read it if you want, tradertalk.cnbc.com, I talked about a study that Schwab did in 2022. They looked back at the last 20 years, and what they saw was there's been a decline of at least 10% in the stock market in 10 of the last 20 years. 50% of the time, there's at least one decline of 10% or more. And the average decline of those is 15%. And despite all of this pullback, in most years, stocks were up. There were positive returns in all but 3 of the years. So a pullback is very common. The problem you have here is what's called recency bias. Everybody thinks, oh my God, look, the market keeps going up and up. Therefore, the market must keep going up and up. And of course, that's wrong. It's called recency bias. Recency bias means you only believe the stuff that's happened recently and you don't pay any attention to stuff that used to happen before recently. Market used to be a lot more volatile. It's been almost straight up for 5 months. That's what's unusual. That's weird. So, don't get trapped by recency bias. Overall, this is one of the strongest markets I've seen in many, many years. Now, in 6 months, it may be different. But the secret here is don't try to time the markets. Stay invested. You don't know when the best market days of the year. If you're not in them, you're not going to have any advantage. You don't know when the worst days are either. You don't know nothing. And by the way, neither does anybody else. Nobody, no one will tell you. And there's another 9 months of trading left. Nobody will tell you when the best days in the next 9 months are. And if you're not there in those handful of days when you have the biggest advances, you're not going to be up. You're not going to outperform the market. You don't know when they are. That's why you stay in. That's why you understand your risk tolerance and have a long-term plan. And if you don't know how to do that, get a financial advisor. I am a big backer of financial advisors, providing they're reasonably priced.
Yeah, exactly. We can't predict the future, so it's good to have that long-term view that we've talked about. But yeah, thanks, Bob. That is all of our questions for this week. Thank you to everyone who sent in questions. Keep them coming. Leave a comment, and I will get to those for next time. Bob, I hope you have a nice weekend, and we'll talk again.
Thank you, Katie. And thank you, everybody. Good questions as always.
Yes, great. Thanks.